In this video, we are going to talk about what is scaling. I'm going to show you an example of a scaling in and scaling out trade, and I'm going to go over tips for scaling in and scaling out. So let's get started. What is scaling? So scaling in trading is whenever you add or remove size from your original open position. So the whole idea of scaling is you're either adding to your existing position or you're taking some shares off the table from your existing position. So that comes in two forms. There's something called scaling in and there's something called scaling out, right? Now let's break down scaling in first. So scaling in into a trade means when you enter your first trade, you enter just a fraction of the total position that you intended to trade. And if the trade works out, then you add more to your position. So for example, the idea of scaling in is, let's say you see a trade. You see that this trade looks great. Now, let's say you want to buy 100 shares of this stock. This stock is trading at $10. Now, instead of you going and buying a full 100 shares on your first trade, the idea of scaling in is where you maybe buy 50. Like, you know what? I'm not that confident in the trade. Maybe I don't have all the confirmations. Maybe I'm just kind of a little shaky right now. Maybe I've had a bad trading week or a bad trading day. So I want to size down. I want to cut my size in half. So instead of you buying your full 100 shares here, you buy 50 now. And if the trade works out in your favor and keeps going higher, you then buy more. And that's the idea of scaling in. You start building a position. You start building a larger position for yourself. So let me show you an example. So if you look right here, we're looking at Tesla's 1 year, 1 day chart, which means each candle represents information for 1 day. And we have about a 1 year worth of information almost, right? Now, looking at this chart, the idea of scaling in would be you see Tesla breaking this important 240 level. Once it breaks 240, you're kind of like, you know what? I want to buy 200 shares, but I don't know if that's a strong break. Or maybe once again, I've had a bad trading week or bad trading day, or I just feel out of momentum or out of rhythm. I'm not sure if I want to take on a large size. So instead of me buying 200 shares on my first trade, I'm only going to buy 100. So you buy 100 shares at 240.5, right? So you are building your position, and then obviously you're going to build it by scaling in. Now, when the position goes your way, let's say everything looks good, you're like, okay, this trade looks phenomenal. I think I should build my position. Now what you do is you scale in. And now at this point, you're adding more shares to your existing position. So your existing position was at 240.5, right? Now, beyond that, once this happens, you're now building your position. Now, as your position is being built, one thing a lot of people tend to confuse or they don't understand, they're like, wait, why would I add more at 245 when I could have just bought 200 at 240? Well, that's the downside of scaling in. The downside is obviously if you were to buy your full 240 or your full 200 shares at 240.5, right? If you bought all of them here, obviously your profit would be a lot higher. You would obviously have a lower cost average on the stock, and that would make a lot of sense in terms of profitability. But the idea of scaling in, and this is why it's important to understand, is it's not something you're doing every single trade. It's not something you're approaching with every single stock. Like, okay, I'm going to scale in. That's my strategy, right? It's only applied when maybe you're not confident. Maybe you're uncertain. Maybe you once again came off a bad trading week or bad trading month or bad trading day, whatever the case may be. Or maybe you've been all over the place and you're trying to build momentum. So instead of putting out a lot of risk on your first trade, you put out a little bit of risk. It's kind of like dipping your toes in water. And then if the water is warm enough, you jump in. Now, if you dip your toes in water and it's not warm enough or it's too cold, you might say, you know what, never mind, let me back out. Now, when you back out, by sizing down, by entering 1/2 of your position, 1/3 of your position, whatever way you want to enter, allows you to dip your toes in water and not really put out major risk. Yes, obviously, if you don't put out major risk on your first trade, that the downside is you won't make a lot of money, right? That works hand in hand. Obviously, the more risk you put out, right, the more profit you're gonna make. But if you put out less risk, it's harder to make the same amount of profit. So don't look at it from that perspective. Now, this perspective, if you're someone that gets caught in fake outs, if you're someone that is ever uncertain, once again, scale in, build your position. Even if you want to buy 500 shares and you're uncertain, just buy a little piece, buy 100 shares, buy 50 shares. And I do that a lot of times myself. If I get into a trade and I'm like, I don't know, or once again, I'm kind of feeling iffy about the trade, cool, I'll buy 50 shares. I'll buy 10 shares. I'll buy 200 shares, depending on the stock, obviously, or the trade. I'll buy a little bit, and if it keeps going my way, I'll add more. Now, I know to a lot of people, adding or buying at a higher price is just doesn't make sense. But you have to understand, in trading, that's going to make you a good trader. Being able to pay a higher price for something where you have higher confirmation, a stronger trade, and you take the trade from that perspective, right? Buying everything at 240 and selling it at 260 sounds phenomenal, but once again, in the whole trade management concept, what people forget is everything in between, and in between, that scaling in aspect kind of helps you build a larger position. Now, besides scaling in, we have something called scaling out. Now, what is scaling out? Now, scaling out of a trade is when you're in a position and instead of exiting the full position immediately, you exit in fractions. So the whole idea of scaling out is you already have built up a position. You have a position, and now instead of you selling everything in one shot, you start scaling out. You start taking some profit off the table. You start taking some risk off the table. So for example, let's say a stock is at 10. Okay, let's say we have a chart and the stock is trading at 10, right? You get in at 10. You buy 100 shares at $10. Now, when you buy 100 shares at $10, and let's say the stock goes to your profit target of 13. That was your profit target. It goes to 13. Now, once it goes to 13, you're like, wow, I'm up $300 on the trade. What can I do at this point? Obviously, there's a lot of different ways you can approach this trade, like I showed you in the trade evolution aspect. But one way or one thing you can do at this point is say, you know what? It hit my profit target. I want to sell, but I don't think I want to sell all of it. So I'm going to sell 50 shares here. Me selling 50 shares, what happens is I locked in profit. I have locked in profit because remember, the profit you guys see on your screen is not your profit until you hit sell, until you are out of a trade. So if you see 300 on your P&L and you still have an open position, you have not made 300 yet. But locking in your trade and selling 50 shares, you have now locked in $150 profit. You have recognized $150 as your profit. Now the remaining 50 shares you own, what happens with this is you have taken risk off the table. You have less risk available out there. You put less risk out there. Your risk goes down. Obviously, when your risk goes down, your profit will also go down, which is, 100%. It's combined with 1 and 1. But at this point, it's easier for you to manage this trade than holding the full position and seeing that price fluctuation, right? And these are things you're going to learn about yourself as you progress. If you start learning that if you are up $300 on a trade or $3,000 on a trade, right, and your emotions start going all over the place, the best thing for you to do at that point would be to scale out. Take some size off the table. Play with smaller size, especially if you're in the green. And another issue this pops up with people is when people have a hard time locking in profits. If you're someone that has a hard time locking in profits, make a rule that every time it hits my profit target, I'm going to take half off. That's my rule. Why? Because for me, I have a hard time taking profits. If that's the case, I'm going to sell half. I'm going to sell 1/3 of my position, maybe 2/3 of my position. Whatever the case is, like that's a rule. Follow it. And the whole idea of showcasing scaling in and scaling out is because these are techniques and methods for you to approach the market in, depending on how you're trading, depending on what you need help in. So if you need help, once again, in locking in profits, or you need help in, building a position, or every time you enter a trade, you realize that the trade goes against you, cool, size down. If the trade does go in your favor, size up, add to your position. Same thing with scaling out. If you're up 50%, if you're up 10%, 20% on the trade, whatever the case may be, scale out. Take some profit off the table. So let me show you guys an example, okay? Now let's look at this stock, Roku, right? So we're looking at Roku right here. So when you look right here, the first entry that we took was about at 131.20. That's the first entry. So we take a full entry, we don't scale in, we buy 200 shares right at 139, 131.20. So we buy about 200 shares right there. Now after we buy 200 shares right there, the stock goes from 131 to 139. It's facing a major resistance level. Now as it's facing a major resistance level, we as traders go, you know what? I see this level before. I saw it got rejected around 139, 140 before. It's there again. So I don't know. I'm not as confident. I don't want to lose out on some profits. I'm up well on this trade. So you know what? I have 200 shares. So let me get rid of 100. If I sell 100 shares right now, I still own 100. But at this 100, I locked in profits. My profits are locked in. My risk has been decreased. So if this does get rejected, I already locked in a good amount of profit and I've already decreased risk. Now, obviously, the downside of that is if the stock does go up like it did here, you miss out on making this much money on the remaining 100 shares that you sold here. But like I said, it's all a give and take. You as a trader should understand that. You should understand that I'm putting out less risk. If I put out less risk, yes, I can potentially miss out on this trade moving forward, right? And if I do put on less risk, I'm also locking in profits. Like I'm showcasing that I'm green. I'm showcasing I made X amount of money. And then obviously you can always get back in. Like if the stock breaks 139, breaks 140, you can always buy for a little higher price where you have a higher confirmation, where you already locked in profits, where you have reduced your risk. So that's the whole idea of scaling out. That's the whole idea of scaling in, right? So now let me talk about some tips and then I'll show you one more example. So some tips for scaling is don't add to losing positions when scaling in, right? Like do not add to a losing position, guys. Like this should never happen. Like you do not average down. Like a lot of people, follow this rule of averaging down. Do not average down. I think the only time you should average it down is if you're investing in the long run. Like if you're going to hold something for years. But if you're trading for a week, 2 weeks, 3 week hold, or especially an intraday trade, you should not add to losing positions, especially if you're day trading, right? Meaning if you buy a stock at 10 and let's say your stop loss is at 9, what a lot of people do is the moment the stock goes to 950, they buy more, right? The moment it goes to 9, they don't sell, they don't exit their position, and then it goes to 840 and they end up buying even more because the way our minds are wired is our minds are saying, well, the stock is at 840, I pay 10, so this is a deal. So let me buy more and add to my position. Let me average down. Guys, do not do that. Do not add to losing positions. Please, don't do that unless you have a legitimate reason, and that legitimate reason comes down to you maybe investing in the long run. But if you are day trading, don't average down. Like this legitimate reason would be like 0.0001%, right, of like 1,000,000 trades, right? Like you'd maybe have a legitimate reason out of let's say 10,000 trades or let's say 1,000 trades, you'd maybe have one that has a legitimate reason. Like if you have a legitimate reason, quote unquote, for every trade on adding to losing positions, just look at the aftermath. The aftermath is it's probably going down, right? Now there are times where people add to losing positions. They buy a stock at 10, right? Stock goes to 7, they buy more, it goes to 5, they buy more, and then one day it pops up, goes to 11, and then starts dumping again. People get lucky here. Like, unless you kind of have some catalyst, some news, or some set of research you did, cool, fine, average down. But I really, really do not recommend it as a trader. You should not, once again, should not average down. Do not add to losing positions. Like, make this a rule. I'm not adding to a losing position. If I'm down, I will cut my losses, I will exit, but I will not add to a losing position. Next, if you add to a winning position, look at the added position as a new trade. So for example, let's say I buy a stock at 10, and let's say that same stock goes to 12. And I'm like, you know what? This looks like a great trade. Let me buy. I want to add to my position. Now, when I buy at 12, I need to look at this as a complete new trade. I need to ignore the fact that I own some shares, and I need to look at it as in like, okay, the stock is at 12. Would I buy it? Would I not buy it? Now, the reason for that is a lot of people tend to look at their existing position, and it becomes very hard for people to add add to their position, because they might say, well, I got it for 10. It's now at 12. Why would I pay more? But that's only happening because you're factoring in the part that you own some shares at 10, right? But if you just say, okay, it's at 12, I'm not looking at anything else. Would I buy this as 12? Do I think it has a high probability of going up at 12? What's my reward to risk ratio? And you do all that good stuff, that will give you a higher chance of success instead of factoring in the old concept. Next, scaling out works well in range-bound markets, right? So scaling out works very well in range-bound markets, and scaling in into winning trades works well in trending markets. So for example, if let's say a stock is going up, it's trending, it consolidates, this is a good time for you to, let's say, exit or take some off the table, right? You can set your levels and see what levels you're obviously going to take some profits off. And if you want to scale in and let's say it continues and it's a trending stock, this would be a good point to add to your position and scale in. Understanding that is very, very important. Next, understand when you scale in, your first stop for existing positions should not be at the same point as the first position. So for example, you buy a stock at 10, you put your stop loss at 9, okay? You take another trade, stock goes to 12, you buy 100 shares at 12, you should not put your stop loss at 9. You should look at this as a new trade and find a level of stop loss that makes sense with reward to risk ratio. And obviously, if you're up 20% on a trade, guys, right, your stop loss at this point should easily be moved up. Should not be here. If the stock is at 12 and your stop is still at 9, that's a problem, right? That's an extreme problem right there. Next, if you are ever uncertain about a trade, go in with smaller size and then add later. If you guys see a stock, it looks like a great setup, but doesn't look like the best setup, and you're kind of uncertain, you're kind of iffy, and you want to buy 1,000 shares, don't go in with 1,000 shares. Size down, buy 250, right? Buy 500, buy even 100, just to kind of feel out the trade, right? Either or, do any of these. The whole idea is for you to build a position, get a feel of the trade, and then if it works out, you're like, all right, buy more, right? That's how you need to approach it. Finally, if you are uncertain about a position, like let's say you are in a trade, scale out and reduce risk. Let's say you get into this stock at 10 and you have 1,000 shares. Now, as the stock goes higher and higher, you might get to a point where you're like, okay, it's beyond my profit target point. My profit target was 13. This stock is now at 15. What do I do? I'm super confused. If you're ever at that point, guys, just take it off the table. Take half off. Tell yourself, I'm up 5 grand right now because I have 1,000 shares at 10. Stock is at 15. I'm up 5 grand. Let me sell half and let me lock in $2,500 right now, right? And let me hold the remaining 500. Or let me hold 250. Right? Whatever the case is, but let me at least sell half because I'm uncertain. I'm very confused. The stock has been going up consistently and I just don't know where to sell. I'm very confused. Take some risk off the table, right? Now let me just show you one last example and then wrap it up from there. Let's say we take this trade. Apple bottoms out at 142, starts consolidating, and you want to buy, let's say, 100 shares. So instead of you buying 100 shares right off the bat, you get in and you're like, you know what? I'm going to buy 50 shares. So you buy 50 shares. Stock gaps up, has strong earnings, market looks strong. You buy 50 more, right? Now at this point, you own 100 shares of Apple. Now as Apple starts going up slowly, let's say it hits 195. It hits a very critical point. As it hits a critical point, obviously you can sell your full position here, but you might say, you know what? I think Apple's going to go higher. It's probably going to have a bad week, bad month. But for now, I'm comfortable in holding it. I'll hold it for a few more weeks. But I'm up a good amount on my trade. So what you can do at this point is take some off the table, lock in 50, right? Lock in 40 shares, lock in 60, whatever you want, right? And lock that in. You've locked in the profits. You've taken risk off the table. And now at this point, if the stock, let's say, breaks out of the 195, you can always say, you know what, let me buy more, Now I have a higher probability, I have reduced my risk, and I've added more. I've scaled that, I've scaled back in, which is totally fine. Or sometimes what people do is if they have 50 shares here and 50 shares here and the trade looks great, they might say, okay, add 200 shares here. Now I have 300 shares, right? All right, it looks great, gets rejected, pulls back, breaks out again. Okay, add another 100 shares, right? So they start building their position. And obviously, as you're building your position, you start creating this huge green cushion for yourself. And obviously, your stop loss gets moved up, and you have a tighter and tighter stop, and your profit to loss ratio just becomes massive. Now, just to recap everything, scaling in and scaling out is very important. You as a trader just need to understand when to use it, when to apply it, and you also need to understand more about yourself, which we'll cover in the psychology section and the mindset aspect. And the way you're going to learn all these things is by actually journaling your trades, understanding, do you sell early, do you sell late, do you panic on your first position, where are your issues happening, and the whole goal is to break that down and understand each and every single step along the way so you as a trader can progress and understand all of the components that go behind the scenes on actually becoming a successful trader.